some processes, just going through some training on how to execute a breakout trading method, and then talking about some pros and cons of different ways to, for entry. Today we're going to talk about trade management and some pros and cons behind that. I'm going to try to keep it fairly quick. I tend to go about a half hour for each of these, but we'll try to keep it a little bit quicker today. I'm going to start with the forex side of things. We'll talk about what's happening in that forex market, utilizing a very simple breakout style strategy there. A different breakout strategy though from what we utilize in cryptocurrencies or in the futures market. Not that that same strategy couldn't be applied into forex. I just look at forex a little bit differently because of the market and the way that market actually works. It works differently than the futures market. It works slightly differently than the crypto market, in that they're just different styles. One's utilitarian, one is speculative. So, forex is a utilitarian market with the speculative side. Futures is wholly speculative, as is crypto for the most part. Crypto does have a little bit of a utilitarian side of it, but it's not there. Crypto is pretty much wholly speculative right now until it's got a wider adoption and used in a greater manner for actual business. So anyway, let's jump over here. We're going to start with this chart over here, and where is it? Right here. We'll start with this one right here. Starting the forex side of things. So forex side of things, we're looking at currency strength to identify which currencies we might want to trade. And I've talked about this before. It's a pretty darn simple process. What we do is we look at which currencies are moving, which this shows us which ones are moving to strength, which ones are moving to weakness. We look at which currencies are actually moving, which tells us, hey, we might want to be able to pair these together. But that's just the start of it. We still have to look at more information than that. We still have to give some consideration to how much has it moved already. So if we were to look at, let's say, the pound, the pound is a weak currency here, the yen is a strong currency here. We have to give some consideration to what it's currently doing and how much it's already moved, because what we don't want to do is, get into something at the very end of a move. So, the pound, while it is a weak currency here, and the yen, while it is a strong currency here, we can see that coming into this session, we're starting the US session right now, it's already moved considerably. It's moved quite a bit. As a matter of fact, its typical range is about 107 pips on a 15-day basis, about 100 pips, 93 pips on a 5-day. I round. I mean, the exact numbers are here, but I again, like I've talked about before, I look at areas. Just round. Don't, use whole numbers. Make it easier on yourself. It's probably not going to move exactly 107.7 pips today, right? It's going to move around 110 pips. It's going to move around 100 pips, depending on the 5-day or the 15-day range. Anyway, ultimately, we're taking that in consideration. If we're looking to go short on this, which is the current trend, how much, quote, gas is left in the tank? How much could we really continue to move, if we took a short position here? Probably not a whole lot. It's not really giving us a whole lot of potential opportunity. If we've already moved 106 and we have to break below this, we'd have to move 126, and that's pretty much outside of the range. It's a pretty good ways outside of the range for that 15-day or 5-day period. Now the 30 days obviously is longer, but that's because of the increased volatility that we had over the last month and a half, really the last month still, with so much volatility around the coronavirus. As those larger moves start aging off, we're going to be, back into the tighter ranges that we were seeing pre economic turmoil from this virus thing. So, not a whole lot for us to really worry about right there on this one. So then we start looking at others. Well, are there others that haven't moved that typically move? And just, looking across my display of currencies over here on the other screen, I don't really see any that are out there. I mean, the ones that we do see that haven't moved very much are ones like, well, if I look at ranges, like the CAD yen, for example, it's moved 23 pips. The average is about 50 to 70. Yesterday it only moved 40. Just using mean reversion, that tells us we should have a decent day at some point where this kind of snaps back to what its typical range is, but what way is it going to go? It's trading. These two are trading right with one another, so we're not really seeing a whole lot there. So at this point, our currencies that are moving have already moved quite a bit. Our currencies that have not moved, that have current day ranges that are small versus their typical range, are trading right with one another. So there's not a whole lot for us to really get involved with at this point. So this is one of those days where you kind of go in, you do your homework, you look, and you go, well, there's, we talked about filtering over the last couple of days. I'm looking at my first filter here. Some things are sifting through. I go to the next filter, which is, looking at my current range versus the average ranges to see if I've got opportunity to actually trade those. And that's where we stop. We're like, yeah, we don't really have much going on. Now, there are some in here, coming back to regular breakout, just straight breakout strategies that we could potentially look at, but that's not how we're trading the forex right now. So let's leave that. So for forex, I've got nothing going on. Oh, by the way, yesterday, I did put a trade on. Just to give you a quick example, I mentioned sometimes you have these trades that just don't go anywhere, right? So we put a trade on yesterday looking for a breakout. Dang it, why did that snap back? I thought I'd turn that off. Stop it. All right, here we go. So we put a trade on yesterday on the CAD yen, and it broke above. It popped us in. We had this parked here, and shortly after we ended our call, it took us in and actually moved considerably to strength. Looks like we were going to continue on, but then it just never went anywhere and ultimately floated back and took us out for a loss. Now the beauty of this, as we talked about, just looking at math, right? The beauty of this is, I had a 1% risk, and to start it off with a 1% reward. But as this moves in my favor, I ended up stopping out. It stopped me out for a 0.7% risk or 0.7% loss. So we're talking about, the losses being smaller than our average wins over the long term. You're going to have this happen where it comes up, puts you in, moves maybe a little bit, and comes back and takes you out. But every time this moves in our favor, it's ratcheting off risk. So what we end up with is, while we're having a consistent reward of 1%, every time we take a loss, it's going to be less than 1%. And typically on average, that's going to work out to, that point, anywhere from 0.4 to 0.6, kind of range. It seems like on average is where that typically works out. If you're doing all the things that we talked about on the front side of this, right? And when you've got that, 1% gain on your winning side and your average loss is, let's say, 0.6, you can almost flip a coin at that point and have a positive outcome over the long term, which is that's what we're looking for, right? We're looking for that positive outcome over the long term. It's slight edge. All we need is a slight edge in order to be profitable in trading. In order to get that edge, you've got to have a consistent process and a consistent way of approaching the markets. And that's what we're trying to get to here. So let's get this going. I'll get this out of the way, and we will pop over and talk about the futures market. Just get my charts back the way they were before I leave, and then I wonder what's going on with my charts. All right, so over here in the futures market, this is where we've been spending our time really talking about utilizing support, resistance, trend bias, so on and so forth. And we talked yesterday and the previous day about breakouts. That's what we're spending our time on this week. We're spending our time this week talking about breakout trading. Next week, we'll talk about pullbacks, trading pullbacks. The following week, we'll talk about a combination of pullbacks and breakouts. So the purpose of all of this is to give you some different ways of looking at the market, some different strategies, base levels of strategies, along with pros and cons that you can now start doing the homework. And I mentioned yesterday and the day before and in previous weeks' time, it's so important to actually do the homework. You've got to put in the work. You can't just go pick up somebody's trading strategy and think you're going to apply it and get the same results, because you absolutely won't. You've got to put in the work to develop something that works for you based on your risk tolerance, your mindset, your trading appetite, the time frames you're trading, so on and so forth. Once you do that and actually test it, and you've got a large volume of back tested trades, and then you forward test it in a paper trading account, you've got a large volume of forward tested trades. Now you've got something that's actually going to give you, you understand your expectancy, you understand your potential drawdown, you understand strings of losses, you understand strings of wins, your subconscious buys into it. Now you've got a trading plan. Picking up a trading plan that somebody wrote and sent you a PDF on, or you downloaded an ebook from, X marketer, or you went to a training class or a couple of training classes from this person or that person. Those are awesome. They're great places to start. But you still got to turn those trading strategies into your own. That's the goal here, is to give you some basics so that you can do this on your own. So anyway, we've been talking about breakout trading over the course of this week. We've talked about what it is. We've given some examples of different ways you could trade a breakout yesterday, meaning just a break. You've got a level where over here. You've got a level that's set and you break above it. So there's that potential of breaking above it and just going in as it breaks. There's also the way to let it break that level, close above, which is your confirmation. The candle's closed above that level is a confirmation. Let it move on and then come back to your level and then trade off of that level from there. There's different ways to do that. That's kind of more of a break, pull back, strategy, but people call that a breakout as well. And there's pros and cons to that. We talked about those pros and cons yesterday, so I'm not going to get into that. Again, let's talk though about trade management, because it is important to figure out where to place our stop loss, so we need to trade with a stop loss, and where to place our take profit, and how do we figure those out, and what are some processes of doing that. So yesterday, was an interesting day. We had some news. We're going to talk about news tomorrow, because that's another important thing to keep in mind is things that are happening in the marketplace. Because aside from the breakouts, aside from whatever strategy you're utilizing, there are things that can impact that strategy, and those are news events, and we haven't discussed that yet. We're going to get into news events when we talk in class tomorrow about things that are happening and how they might impact us. Today, let's talk about trade management, risk management, as it goes into things here. So we've talked about the breakouts. We've talked about where you can get in, where you can get out. We've talked about the process that I utilize to look at bias. So looking at multiple time frames on bias. And just a good example, by the way, is mixed bias. So on our S&P, which is the chart here on the left-hand side, we have a long bias on the 4-hour and on the 30-minute. They're both in a long bias. Oil has flipped on us. Oil had a little bit of a run yesterday, all the way up to these blazing heights of $14. Anyway, oil had a little bit of a run yesterday. Its 30-minute bias has changed, so now the 4-hour bias and the 30-minute bias are mixed. We're going to not worry about oil. Gold, the bias has changed. We've got a downward bias now on the 30-minute, which is contrary to the 4-hour bias on gold. So we're going to not worry about gold either. So anyway, back over here to the S&P, and not thinking about news or anything that's going on right now. If we're looking at intraday trades, let's say here on the S&P, what we're watching, as we mentioned, we've got a long bias that's on the 30-minute. We've got a long bias on the 4-hour. They're in agreement with one another. We would be looking for long trades, and we'd be looking for long trades based on those breakout areas that we identify, whatever time frame you're looking at for your breakout. Once we identify a spot to break from, we have to figure out, okay, this thing's broken this level, and I'm going to enter a trade. Where am I placing my stop loss, and where am I placing my take profit? Now, we've discussed before, in order to have a positive expectancy in our trading, we really need to have a profit point that's 1.5, 2 times, 3 times, excuse me, I'm out of water, our initial risk. So we need to have profit that outweighs our risk. And you can do that a couple different ways. In the forex side of things, I showed you a breakout box strategy, which can be utilized in futures markets as well. But I showed you a strategy where we've got a 1-to-1 risk reward. Initial risk, reward 1-to-1. But when that goes in our favor, we're ratcheting off risk. So we're giving ourselves a chance to have a reward on average that outweighs our risk. The average reward is always going to be higher than our average stop loss or average loss. So we don't want to do the same thing here in the futures market. So different ways we can look at that. You can look at static numbers. You can go back, do the math on the average, for what's going on here. Some folks just they say, hey, in the S&P, a 5 or a 10 point range is fine for me. Okay, so you could just use something static like that. You could say, well, if I'm entering, at 2,900, if I'm entering looking for a break of 2,900, then I could keep my stop down here at 28.90, and that would give it plenty of room to chop around and move before it moves in my favor. And the range on this is all right. So I could put my stop loss at 29.20. So just using whole numbers. That's one way to do it. For me personally, that seems a little random, but it is a way a lot of people go at it. They'll use a 5-point stop or a 10-point stop or whatever it might be, depending on the time frame that they're trading, and they'll just keep it at a static number like that. So if you're using a static number, that's say a 10-point stop, then your take profit would be at 20 points, right? It needs to be something that's, for me, I feel like, when you're utilizing and you're creating your risk and you're creating your reward target, it needs to be something realistic. Don't look at a 5-minute chart and put a 100-point reward on there. Yeah, it looks great from a number aspect, but it really is what's coming back to what we talked about before. How likely is it to move that much in a day, right? Don't get the pie in the sky rewards out there in your head. One thing I like to do, I feel like a great way to manage risk is to manage it based on something quantifiable, right? We talked over the last few days about what we're trying to develop here is a quantifiable strategy, things that we can actually measure, that we can use to filter our process to identify trades. And from a trade management aspect, I feel like it's good to look at the same thing as different ways to manage our initial entry and our risk as well. Some things I like looking at for this would be base it on average trade range. So we can look at a few things. We can look at the average trade range for the instrument that we're trading, and that gives us a way to quantifiably set our potential stops and our potential take profit multipliers based on how that instrument actually moves. So how do we find the average trade range? Because it's going to be different for the ES, and that allows us to have a different trade range for gold over here. It allows us to have a different range for oil, and any other instrument that we're trading. We can do it on the average trade range. So to do that, most different, let's just expand this one out here. So if you're looking at this, every software, trading software that you use has indicators that are part of it, right? So sometimes they're called studies. Like here in TradeStation, they're called studies. If you go to MT4, they're called indicators. If you go into TradingView, they're actually called indicators there as well. But you can put different studies on your chart. So what we could do, if we want to figure out what our average trade range is, we can go here to the ATR, average true range. And this is going to give us a little chart at the bottom and show us show us an oscillator for, an oscillator is one that kind of moves, and to show us an oscillator for how the range changes intraday. Obviously, on an intraday basis, we're going to have times when, the markets aren't real heavily traded, and we're going to have a smaller range, and there's times when you have a lot of activity, you have a wider range, and this is looking over an average period to give us information about what that range is. So if we put the oscillator on here, it defaults to 14, so it's looking back and giving us an average over the last 14 periods for whatever we might be on. We're on a 30-minute chart here, right? So on a 30-minute, right now, looking at the last 14 periods, average range for, the S&P is about, 8.5 points, 8.7 points. But if we really kind of look through here, you could almost just put your line and kind of look through here and say, well, because we're looking more during key parts of the day when things get a little bit wider. Things get wilder during times that the U.S. market is active, right? You've got off trading hours, which are electronic, and you've got the live trading hours, and you have more. If you do a volume chart on this, you'd see that you've got significantly more volume as the live active market session is on right here. So regular trading hours, you'll see a big spike up in volume. So we'd want to look at what's really happening at those ranges during the times that we've got volume in the marketplace. So, we can just look across here and say, well, that's really closer to, 10.6, 10.7, maybe even 11 points. And I'm just holding my cursor. I'm not looking at the box that's popping up. I'm looking over the far right-hand side at this number that moves up and down as I move this, right? So, actually, it tells me right here as well. I never even noticed it's got the ATR listed there at the bottom. So I guess I can look there. But if we look during those times, kind of right across here, the last few days during that live active, regular trading hours active session, we're probably around 11 points. So you can use that information and say, okay, well, if I'm using something quantifiable, the range here is about 11. So now you can either take that and say, okay, when I enter and this breaks out of a specific area, maybe I'm looking at 2,900, right? If it breaks 2,900, then I'd look to go long on. I'm just throwing out hypotheticals. We haven't put all of this because there's still more we need to put into practice. But if it breaks this level up here at 2,900, then I'd want to go long. Well, in order to do that, how much can I risk? Well, the typical, most people say, keep your risk fairly small. 1%, 2%, maybe a max of 5%. That's another number that you've got to play around with. You've got to think that through and really understand what your expectancy is. No one can come in and say the perfect amount of risk is X, because that depends on you. It depends on me. It depends on, Susie's risk and Todd's risk. They're going to be different than what you and I are comfortable with. Also, the expectancy is going to be different. If when you look at your trading plan and you look at how we manage stop loss is going to play a lot into this as well, especially as you look at your large breadth of back testing and forward testing. You look at all your data that you've collected. That's also going to tell you what you can risk, right? Because you've got to consider once you take all of those trades, you're back, like I said before, you're back testing 100, 150 trades. You're forward testing 100, 150 trades in a paper account. Now you take all that and you put it together, you've got 300 trades. Over the course of 300 trades, based on your strategy, you're going to see patterns. You're going to see series of losses over that. You're going to have, just like if you flipped a coin, if you took a coin right now and you started flipping it, you're going to get a series of heads, you're going to get a series of tails. It'll be the same thing with your trading plan. Now you're giving yourself a better expectancy than just a coin flip because you're using other tools to your advantage. You're looking at what the bias is, you're looking at entry points, you're looking at so on. You're stacking the edge in your favor, right? But even in doing that, you're still going to have strings of losses. And you're going to have strings of wins. But when we're thinking of risk, we have to consider those strings of losses. So when we do that, we can't say 5% is the perfect amount of risk, because the trading plan that you've come up with, once you've figured out all the different moving pieces, where I'm entering, how I'm ratcheting off my stop, because there's pros and cons to moving stops, where I'm taking profit, so on and so forth, is going to determine, based on the real quantifiable data that you've gathered, how much you can risk per trade. 2% might be better than 3% or 4% or 1% or whatever it might be. You're going to find that perfect mix after you look at the data when it comes down to actually putting that money on the table, because it may sound great and hypothetically to say, I can risk 5% per trade. Okay, how does that 5% per trade feel when you've had a series of 6 losses in a row? Ouch. Ooh, that hurts. If you're risking 1 per trade and you have 6 losses in a row, it doesn't hurt as much, right? But it might be okay. you might be okay with that drawdown because it's expected. You've looked at your data and you've said, hey, in over these 300 trades, I had a series of this many trades in a row, but it came back over time, and you know what to expect. If you understand that, you might be okay with it. But no one can tell you that. No one can tell you that until you've done the work. This is where doing the work comes into play. And I get all passionate about doing the work because it's the piece that everybody misses. Nobody wants to do it. I don't want to do it. Nobody wants to do it. It's boring. Not making any money when you're doing the work. But it sets you up. It's like going to school, right? You can't just jump out and start doing brain surgery. I hope these guys don't do that, right? You got to put in the work. I'm sure the brain surgeon didn't like sitting there and studying hours on end of books and doing hypothetical, surgeries and doing practice surgeries and doing all the stuff that wasn't actually what he wanted to do in the end, but he did the work. Or she did the work, right? It's the same thing with trading. So I hope you're getting something from this because I'm really passionate about it because so many people just want to take a plan. Just tell me what to do. I can't just tell you what to do because you're not going to do it unless you actually put in the work to understand how it's going to work for your personality. Anyway, I'm going off on a long diatribe here. Looks like we just had some news actually. 7:30. Yeah, we just had some news. Big spike over here. Blew through 2,900. Anyway, we'll talk about news tomorrow. So anyway, what was I talking about? trade management, risk management. So when we're managing risk, look at something quantifiable. All right. So we mentioned here. So we kind of looked across what our active where our average trade range goes over the last few days, looking at our active time periods. So we kind of looked across here and we agreed it's about 11 points. Maybe it could be a little higher, a little lower, but it's about 11, right about 11 points average trade range on this one. Now, if we did the same thing on oil, it'd be a different number, and that's where I like it because it's something that's unique to the instrument that you're trading. So if we say okay, well we know on average we got about 11 points, then we could say if it breaks 2,900, we could look at 2989 as our stop loss point, and then we could use a multiplier of that for our take profit point, and it's something that's based on quantifiable data, right? So now we've got instead of just saying it's going to be a 5-point stop loss across the board no matter what we're trading, we've utilized real data to get a quantifiable number of where we potentially want to place our stop for that. Now it comes down to what's our multiplier going to be? Is it 2 times the risk? Is it 2.5 times? Is it 3 times the initial risk that we want to set our take profit point? I would recommend at least 1.5. But 2 or 3 is better. 2 or 3 times your initial risk is better. Simply from a mathematical perspective. Now again, as I say that's going to change as well depending on how you manage your stop, because there's other stuff that come into play for that. So let's talk about that. We've talked about an easy way to quantifiably find our initial risk, and that's utilizing average trade range. So we talked about a way to quantify that. And there's indicators too. There's indicators you can put in your chart that tell you what the average trade range is. As opposed to just putting the oscillator on there. There's some you can have an indicator written that'll say I only want to see my average trade range over the last 14 periods during these specific times of day. So you could say I want to see the ATR between 9:30 Eastern and 12:30 Eastern, which maybe are your periods of the highest volume, right? And then I want to see that average during that time of day over the last 5 days or 7 days or 10 days. Programmers can write that for you if you want to get down to that really granular level of detail, and it'll just spit out a number on your chart. Every day you log in, you look at that number, and maybe one day it's 10, the next day it's 10.1, whatever it might be. But if you want to get to that really granular level of detail, you can. I don't think you have to go quite that far. You can utilize super simple tools like I just did here and get your baseline. It's about 11, because again, nothing's exact. Nothing is. I keep talking about math, and math is an exact science, right? But at the same time, when we're trading, there's human emotion as well. So you're going to have ranges for your support or resistance areas. You're going to have ranges for your average trade range, so on and so forth. But you can get a pretty good idea using the tools that are included without having to have anything coded for you. So okay, so that's one way of looking at average trade range to identify your initial risk, and then utilizing a multiplier of that for your profit taking point. Now there's a couple of schools of thought around managing risk. One is, I've got my initial risk and I've got my profit point, and I don't do anything else. I just let it go. It either is going to come back and stop me out, or it's going to move on and it's going to take profit. Now that method is actually really good. That method works out to give you a really nice positive expectancy over the long term. The thing is, you get these graphs. I probably can't. I'd have to go. Yeah, let's take. I have a little. Just now, I noticed that I didn't have my little time counter at the top of my camera here. So I think I've been talking to just myself, which my wife says I do all day anyways. So no real change. But all the stuff I just talked about with equity curves and with oh my gosh, and trade management and intraday trade management have just gone out the window. So I'm gonna have to do this again tomorrow. Unfortunately, I've got another call I have to jump on right now, and gosh, I'm so sorry. I can't believe that. I cannot believe that. When I went over to my whiteboard, moved the camera over to the whiteboard to kind of draw my little equity graphs for you, which you can kind of see back there in the background. You know, I clicked the wrong button. So anyway, I spent like 20 minutes, 15 minutes probably talking about stuff that no one heard. I'll go over it tomorrow. Sorry about that, guys. I got to jump on this other call, and I'll talk to you guys soon. Talking about risk and stuff and managing risk. So I really don't know where I left off, so I'm just going to start kind of back from the middle. We were talking about different ways to manage the entry and look at risk, and we talked about utilizing the average trade range as a way to quantifiably look at how a specific instrument moves in the day, how volatile it is in the day, and how many points we should look at potentially risking in order to give that instrument enough leeway to move, and based on the trade plan that we actually currently have, right? So in talking about the futures market over here, we're looking at the S&P, right? We're looking at the eminis over here, and we identified, we talked about using average true range, which is a canned study or a canned indicator. It's on every trading platform out there, and it's looking back over a specific period. You can change how long you want to look back. You can go to the settings for your ATR. You made like this defaults to 14, depending on what trading platform you're in, or the indicator that you're using. It might be a different number that it defaults to. This is what it's telling us. It's making this little end bar here. Like right now, it says 10.41 on the far right hand side of my screen. That's saying that even though we had this really big spike right here, that's driven the 14 period range, right? That's on a 30-minute period. If I go down to a 5-minute period, we can see the average trade range is considerably different. If we go down to a 5-minute period, the average trade range is 5.6 right now because of this giant spike. But prior to that, it was in the 3.5 range. So you're gonna utilize the average trade range, or I'm not saying going to. You could potentially utilize the average trade range as a way to figure out what your initial risk could be. So instead of just utilizing some number that you pulled out of the air, 5 points, 7 points, whatever it might be, you could use something quantifiable based on the instrument that you're trading to understand how that instrument moves and calculate your initial risk, right? And then you would use a multiplier of that for our take profit point, whether 2x or 3x. Okay. So I think I hit all of that before I inadvertently stopped my video earlier. So now it comes down to, how do we manage the trade? How do we manage the trade on an intraday basis? And there's kind of what they call the rub. There's the rub. There's where it gets kind of murky, because for some people, you're content to say, I've got a 11-point initial risk, so I'm going to put a 33-point take profit out there. If it gets there, great. If it comes back and stops me out, I'm okay with that. Now, how do you know you're okay with that? Test it. This is where putting in the work comes into play. And I don't know if I went off on my long diatribe about putting in the work again before or after I stopped the last video, so I won't go back into it again. I'll just assume that you guys understand what I mean by putting in the work, because it is so powerful and it means so much to the creation of your plan. Again, you can't just pick up somebody's plan and expect it to work, because there's so many psychological barriers behind that around how you react to the risk that's taken, how you want to manage risk, and how you feel when trades move for you and then come back and stop you out, and so on and so forth. So it's really, really important. And different ways you manage the risk are going to have different outcomes on how your equity curve goes. They're going to have different outcomes on your win-loss ratios. You're going to have a lot of different things. And in order to really understand how that factors into how much risk you can take, you've got to have that large breadth of that large sample size of data that you can look at, right? So anyway, coming back over here, how can we manage the trade on an intraday basis? Well, once we're in a trade, there's a couple different things we can do. We can use that method that we have talked about in the forex side of things, where we, set our entry, set our stop loss, set our take profit point, and then use just a trailing stop. So we use a trailing stop to every time a trade moves in our favor, every time it moves a tick in our favor, we're going to trail off, we're going to ratchet off some of that risk. So that's one way of doing it. The pros of doing that are you're taking risk off the table rapidly. The cons of doing that are you're going to get stopped out a little bit more often. So there's a con to doing that. The pro of doing it works well for folks that are kind of risk averse. Psychologically, hey, I'm taking risk off the table rapidly. So, some folks would rather have that. They're more concerned about that than they are about the flip side, which is, trades coming back against us and getting and stopping out. But just understand, we're going to get stopped out more often when we're ratcheting off risk, especially if we're utilizing a risk reward that's 2x or 3x the initial entry. Because in order to get to that 2x or 3x, typically there's going to be a lot of ebb and flow before it finally gets up there. That 1x, you're looking at your trade range. So, could it very quickly move, 1x your initial entry? Yeah, absolutely. And actually that method of, if you're 1x your initial risk, ratcheting off, pip for pip actually works out in your favor mathematically as well. The other way of doing it is to trail it based on the bottoms of the if you're in a long trade, the bottom of the previous candle. If you're in a short trade, the top of the previous candle. So you've got your initial risk. Let's say again, just using 2,900 as that level, which we were talking about before we had news that blew this through here. But if we were looking at 2,900, let's say, as that initial level, and you had an 11-point risk down here, you could just simply say, okay, this candle closed, so now I'd ratchet up my risk to, I guess an 11-point risk would be down here. Anyway, my bad, looked at the wrong spot. So we'd wait for this candle to close, and then when this candle closes, we would ratchet our risk off, and we'd be at the bottom of this previous candle, or maybe a couple of ticks below the bottom of that previous candle. And then as the next candle closes, we could ratchet off risk again. That's okay too. There's another way to do it. Again, pros and cons to that. Same as we had before. you're going to have a percentage of trades that move up in your favor, and you ratchet off some risk depending on the time frame that you're on. If it's a 30-minute or 5-minute or whatever it might be, you're going to ratchet off that risk. But then the trade may reach a certain point and come back, and it comes back at a level that's maybe a little bit more volatile, and it comes back and goes beyond the bottom of that previous candle and stops you out. So you're going to get stopped out. The benefit of it is you've taken off risk. So the benefit of it is that you're losing less than your potential win. If you still got that 2x or that 3x as your win, when those hit, you're winning significantly greater levels. So again, you're going to end up with this equity curve, where you've got loss, win, loss, win. So depending on how that works, you may be like, oh, my brain doesn't like that, but some people do. Some people are more concerned with ratcheting off risk than they are with that reward. The other side of that is a lot of people manage their trades that way with no take profit point. They just trail their stops at the bottom of previous candles, and that works out. Sometimes that's how you get those trades that just run on. It doesn't happen that often though. So again, one of those things you really have to look at. How often do trades just move? These huge numbers of percent where you'd really be able to take this really outsized win by trailing at the bottom of the previous candles. That happens, and absolutely it happens, but it doesn't happen often. But if you're okay with that, maybe that's another trading method that you could consider. So there's pros and cons to all of it. You're not going to know what those pros and cons are though until you put in the work, right? So I hope this gives you some ideas around what's going on here. News we're going to talk about tomorrow, because news had a big impact yesterday. It's having a big impact right now. It's important to factor in news into your trading plan and talk about it. But I think I've hit the high points of what we wanted to hit. So at this point, we've talked about breakout strategy. We've talked about how to use bias in our favor to determine directionality. And then we've talked about different ways of entering a breakout trade, an actual break it, taking the trade as it breaks on momentum, or taking the trade looking for a break, confirm, and a little bit of a pullback to that level and then move. So we've talked about different ways of doing a breakout trade, the pros and cons behind that. We've talked about quantifiable methods of finding our initial risk points. So you can either just use a static number that you pull out of the air, or you could use something quantifiable by utilizing the average trade range. And now we've talked a little bit about different ways to manage that trade intraday, and there's pros and cons to all of it. And that's what I really want you to be aware of. It's trading. There's a trade-off. Everything's a trade-off. So while some things work well for your psychology and your risk tolerance, they may not work for someone else's. So in order to figure out what those are, that's where you've got to step back and do that back testing. And back testing gives you a fixed period that you can experiment with different ways of looking at your stop loss, look at your entries, look at your stop losses. How are you managing your stop losses? How are you managing taking off risk? Do you want to just simply have a static risk reward, or do you want to ratchet off risk? You're not going to know that until you back test it. Once you figure out the one that you think works well for you from a back testing perspective, now take that and forward test it in a paper trading account for 100, 150 trades. Once you've done that, you're going to know. You're going to know your expectancy, and that's where you can determine how much risk, percentage risk you want to have on each trade. So that is it. I think we've hit it all. We'll be back tomorrow. Tomorrow we'll talk a little bit about news and what we want to look for there, and some news sources that you can utilize to see what's coming up so that you can form your trading day around it. And then I think we'll be able to put it all together and start rolling with a plan for the tomorrow and then into Friday. And then next week we'll talk about pullback strategies, because that's an entirely different trading strategy. A lot of what we talked about with risk management is the same, but the actual strategy itself is different. And then the following week we'll talk about that combo strategy, which I really dig. So anyway, that is it. Have a great day. We'll talk to you.